While Ackman was on CNBC predicting an economic apocalypse, his fund was already deploying the cash from his credit default swap windfall to buy companies he knew would surge once the panic faded. Starbucks, Hilton, Lowe's restaurant brands, businesses with strong fundamentals that had been temporarily crushed by fear-driven selling. To the public, his televised warning looked like a desperate plea, a billionaire waving a red flag for the good of the country. But behind the curtain, it was pure asymmetric positioning. He bought companies whose balance sheets could survive a brutal quarter or two, but would roar back once confidence returned. It was not gambling. It was calculated opportunism. Within months, the Federal Reserve unleashed unlimited stimulus, igniting the fastest market rebound in history, and Ackman recorded the best year of his career. His timing, brutal as it looked, was immaculate. He earned a fortune on the collapse, and an even larger fortune on the recovery. That is stage 4 executed flawlessly. Be the buyer of last resort when everyone else is gasping for oxygen. Now think about what stage 4 will look like in 2025 and 2026. The crash has not hit yet. We are still deep in stage 3, the positioning phase. But history gives us a clear preview. When the break finally comes, whether triggered by cascading commercial real estate defaults, a tech sector implosion, geopolitical shock, or an unexpected catalyst, the panic will be overwhelming. Markets could fall 50 to 60%. Unemployment could spike into double digits. Regional banks will fail in clusters. News cycles will be saturated with catastrophic headlines. Politicians will panic. The Federal Reserve will be cornered, and that is the exact moment stage 4 begins. But if there is one thing history teaches repeatedly, it is that crashes do not feel like opportunities while they are happening. The world looks like it is ending. In 2008, people were not thinking about discounted equity. They were thinking about protecting their jobs, their homes, their families. In March 2020, no one imagined airlines or hotels returning to profitability. They feared bankruptcy. Dominoes, the most lucrative stage of the cycle, hides behind a curtain of despair. Buffett's $325 billion in idle cash is not sitting still by accident. He is waiting for the moment when quality companies trade at prices he has not seen in decades. When the S&P 500 is slashed in half. When blue-chip businesses beg for capital, he will strike the same way he did during 2008. Preferred shares with double-digit dividends, warrants with enormous upside, equity positions at fire sale valuations, and entire companies acquired outright. When only a handful of players have liquidity, they write the terms. That is how fortunes multiply during crises. And when Buffett acts, he rarely acts alone. His capital is gravity. It draws other capital behind it. Pension funds, sovereign wealth funds, endowments. Everyone follows the signal. The paradox of market catastrophes is that they become the cleanest environments for capital allocation. During euphoric bull runs, prices become untethered from fundamentals. No one knows what things are really worth. During panics, fundamentals scream through the noise. Balance sheets and cash flow matter again. The blood on the streets becomes the valuation anchor. Private equity giants know this too. Apollo, Blackstone, KKR, Carlyle. They have been quietly amassing record levels of dry powder, not to invest today, but to unleash during stage 4. When buildings are auctioned at 40 cents on the dollar, when corporate debt trades like distressed scrap, when foreclosed homes hit the market by the thousands, they will buy aggressively, hold patiently, and ride the recovery for a decade. They do not need the public to like the market. They just need the public to be terrified of it. The 4-stage framework is not mysticism or insider privilege. It is simply human psychology repeating itself. Bubbles inflate. Leverage unwinds. Panic overshoots reality. And disciplined capital steps in when no one else can breathe. This exact cycle has replayed across centuries. Tulip mania, the South Sea bubble, the panic of 1873, the dot-com collapse. Different narratives, same emotional mechanics. Every time, the people who understood the difference between price and value walked away richer. Right now, in 2025, the pattern is unmistakable. Stage 1 is done. The insiders have already left. Buffett, Bezos, Zuckerberg, corporate executives. They sold near the peak. They did not need perfect timing. They only needed to exit before confidence cracked. The retail crowd bought the narrative of new fundamentals. It always does. Stage 2 is underway. Volatility hedges are being built. Options, swaps, tail risk, insurance, all accumulating quietly. The public mistakes this for pessimism or paranoia. It is neither. It is the cheap acquisition of optionality. In a bull market, insurance is inexpensive because no one believes catastrophe is possible. That is exactly when professionals load up on it. Stage 3 is happening in real time. Hedge funds are heavily shorting commercial mortgage securities, and overexposed regional banks as defaults accelerate. The groundwork is set. Macro portfolios are already leaning into convexity. Risk managers are preparing reports that most of the public will never read. Everything is silent until the moment of impact. Then it becomes screaming chaos. And stage 4, the moment of extreme fear, is approaching. The signals are already flashing. A recently normalized yield curve after a deep inversion. Commercial real estate distress, accelerating regional bank failures, insider selling matching pre-2008 levels, and valuation metrics far beyond historical danger zones. Every major recession indicator is fully aligned. These are not vague omens. They are classic pre-crash architecture. What mainstream investors get wrong is not their intelligence. It is their intuition. They think they will buy the dip when the time comes. They tell themselves they will scoop shares at 40% off, but when the dip arrives, they panic sell instead. They convince themselves that this time is different, that the world has permanently changed, that tomorrow will be worse than today, that prices will never bounce. The market punishes confidence and rewards discipline. That is the timeless truth. If you cannot execute stages 1 through 3 like professionals do, you can still prepare intelligently for stage 4. Hold more cash than usual. 20 to 40% of your portfolio. Yes, you might miss late cycle gains, but you will have ammunition when assets trade at generational discounts. Consider basic protection. Simple SPY, puts dated. 6-12 months out. Insurance costs money, but losing capital in a crash costs far more. Most importantly, prepare your Stage 4 shopping list. Now, identify the companies with durable earnings, low debt, strong cash flow, and products the world will continue to demand. When they fall 50% or more, emotions will tell you not to act. Every instinct will scream that the world is ending. That is precisely when generational wealth is built. Study the data from past recoveries. Amazon after the dot-com crash. Apple before the iPhone era. The post-2009 financials that everyone swore were uninvestable. The winners in every cycle were companies that solved real problems and endured real pain. Markets do not reward utopias. They reward resilience. The 4 stages shaped 1929. They shaped 2008. And they are unfolding again today. You cannot stop the pattern, but you can choose whether to be crushed by it or to use it. Stage 3 is nearly complete. The window to prepare is narrowing. The crash is coming. The opportunity of a lifetime will follow, and only those ready to act in the darkness will emerge on the other side with everything. This is the point where the pattern becomes irreversible. The reserve currency nation stops producing wealth and begins consuming it. The transition is subtle. At first, like a quiet leak in the hull of a ship, but once it becomes visible, the damage is already permanent. Portugal saw this in the mid-1500s. Its trade surplus vanished. Instead of exporting goods, Portugal began importing nearly everything: grain from Sicily, textiles from Flanders, manufactured goods from across Europe. The empire that once filled Europe with exotic spices and colonial wealth suddenly needed the very staples of life from its neighbors. They paid for this with gold and silver, extracted from Brazil and Africa. But this is the critical nuance. Portugal was no longer producing wealth. It was spending wealth accumulated earlier. The Portuguese crown's spending exploded. King João III poured money into palaces, cathedrals, and the pomp of royal courts. Military campaigns to maintain the empire drained resources as fast as they were discovered. And here is the key that every declining empire has shared. They did not notice the problem because the money never stopped flowing. As long as Brazilian gold ships arrived, the illusion of prosperity endured. The mines masked the decay. But gold is not a productive engine. It is a fuel that burns out. It cannot be reinvested into factories, into innovation, into durable competitive advantage. Portugal spent its future on its past, and when the metal shipments slowed, the country discovered it had built nothing that could sustain it. They consumed instead of producing, and that trajectory is always fatal. The Dutch followed the same path in the 1700s. After a century of extraordinary trade surpluses, Amsterdam, the richest city in Europe, shifted from being the engine of global commerce to the lounge of retired merchants. Wealth made people comfortable. Why stand in shipyards or weave cloth when accumulated capital could be lent out for handsome returns? Dutch investment moved away from industry and production toward finance. They became Europe's bankers, lending to other nations instead of creating new goods. It rewarded them with income. Yes, but not productive growth. The trade balance reversed. Imports rose while exports faded. Payment came from liquidating stored wealth, not generating new wealth. Then Britain repeated the cycle in the early 1900s. By 1900, Britain, the titan of the Industrial Revolution, was running trade deficits. The empire imported food, raw materials, and increasingly manufactured goods it once exported. They financed this with returns from centuries of overseas investments, railways in India, mines in Africa, enterprises scattered across the imperial map. The capital returns were enormous, but they extracted wealth produced elsewhere. They were no longer building engines of prosperity at home. British manufacturing, which once led the world, fell behind American and German competition. Factories shuttered, and the pound began doing what the guilder once had: buying time, not creating value. The United States entered stage 4 in 1971, when the dollar's link to gold was severed, and the trade surplus reversed permanently. From that moment, the pattern was set. By the 1980s, deficits expanded rapidly. And by the 2000s, the USSR was running the largest trade deficit in human history, more than $800 billion annually. The United States became reliant on imports for almost everything: electronics, cars, textiles, steel, pharmaceuticals, consumer goods. The world shipped its production to America, while America shipped only dollars in return. This system functions only because the dollar is the reserve currency. Other nations accumulate dollars for reserves and for trade, so they tolerate the imbalance. But conceptually, this is indistinguishable from the Portuguese and Dutch patterns: a society consuming more than it produces, propped up by the capital accumulated in earlier eras of dominance. Then comes stage 5, currency debasement and money printing, the desperate measure. When deficits become unmanageable and the state can't borrow enough to finance its spending, it turns to the oldest political trick: dilute the money. Portugal did this in the 1550s. Facing shrinking revenues and rising costs, the crown debased the real. The silver content in coins was reduced. More currency was issued than there was metal to support it. Inflation followed. Merchants began rejecting the real or demanding more of it for the same goods. Purchasing power eroded, and by the 1570s, the real was losing credibility. International traders shifted to other currencies. The Portuguese thought their empire still commanded respect, but markets had already moved on. The Dutch repeated the mistake. The guilder, once admired for its conservative monetary discipline, became a tool of fiscal desperation. After decades of borrowing to finance wars and maintain colonial ambitions, the Dutch began inflating the currency. The value of the guilder declined. By the 1780s, the financial center of Europe was no longer Amsterdam. It was London. The guilder became respectable, not dominant. And respect, eventually, is not enough. Britain debased the pound through 2 world wars. World War I forced money printing and a reluctant suspension of the gold standard. They returned to gold in 1925 at an overvalued rate, which crushed domestic competitiveness. When World War II arrived, Britain abandoned gold permanently. By 1945, the pound floated and drifted downward. Money, printing, funded reconstruction, and a growing welfare state. Devaluations in 1949 and 1967 destroyed trust. Each cut was a confession that the empire could not support its currency. The United States entered Stage 5 in 2008. The financial crisis detonated the largest monetary intervention in American history. Quantitative easing, trillions created electronically, $3.5 trillion from 2008 to 2014. Then COVID arrived. Another $7 trillion from 2020 to 2022. The money supply expanded faster than at any period outside wartime. No melting coins or shaved edges, just digital debasement. The effect is identical. The dollar's purchasing power fell. Inflation surged to levels not seen in 4 decades. But here is the difference. The dollar is global. When the Fed prints, it does not only debase American savings, it exports inflation to the rest of the world. Developing nations choke on rising import costs. Countries holding dollar reserves watch their wealth erode. Dollar-denominated debt becomes easier to repay, but groceries, energy, commodities, all more expensive. When reserve currency inflation hits, the world pays the bill. And this is the moment when confidence begins to crack Stage 6. This is when the world searches for exits. Not because it hates the empire, because it recognizes the pattern. Portugal's collapse was visible in the 1570s. Merchants demanded Venetian ducats and Spanish pesos. The Dutch saw the same in the 1700s as reserves migrated from guilders to pounds. The British felt it after World War II as nations dumped sterling for dollars. Confidence breaks silently at first, then violently. That is where the dollar sits now. The signs are visible to anyone who bothers to look. Nations accumulating gold, reducing treasury holdings, experimenting with alternative settlements. BRICS talks of a shared currency. Saudi Arabia pricing oil in yuan. Asian economies bypassing the dollar entirely in bilateral trade. It is not a revolution. It is rebalancing the same. Rebalancing that has happened 3 times before. And once the world stops merely questioning the reserve currency and begins actively replacing it, Stage 7 arrives. Replacement and collapse. Not through treaty or conference, but through usage. Market adoption kills empires faster than armies. When merchants refuse your currency, the throne is gone, whether your flag still flies or not. The transition from the British pound to the U.S. dollar was made official at Bretton Woods in 1944, but it did not happen overnight. Britain was financially exhausted by World War II. Its empire intact in name, but hollow in capacity. The United States, meanwhile, held the world's largest industrial base, and most of the planet's gold. The dollar was not just strong. It was the only currency capable of functioning as a global anchor. The pound collapsed through repeated devaluations, each one a public admission of decline. By 1967, after yet another devaluation, everyone understood the truth. The dollar had fully replaced the pound. So what replaces the dollar? That is the question people debate endlessly. And the honest answer is this: we do not know, not yet, because we are not living in Stage 7. We are living in Stage 6, the global hunt for alternatives. But history does not leave us blind. It gives us patterns to read, as reliable as tides. Replacement currencies do not come from good branding, ideological dreams, or hopeful speeches. They come from real dominance, the nation that controls trade routes militarily, maintains a consistent trade, surplus, and has robust productive capacity. Right now, no single country checks all three boxes. China has the trade surplus and manufacturing capacity, but it does not control the shipping lanes, the choke points, or the blue water navy required to back a reserve currency. The yuan is not freely convertible. Capital controls keep money trapped behind the Great Wall of Beijing, and you cannot hold global reserve status if the world can't move wealth freely in and out of your system. The euro is the world's second largest reserve currency, but Europe suffers structural fractures, aging demographics, fragmented fiscal policy, dependence on foreign energy. Germany produces. Southern Europe consumes. The euro is a monetary union strapped onto a political patchwork. Stability, built on compromise, never the foundation of global dominance. Gold, on the other hand, is making a comeback. Central banks are buying more gold than at any point since the 1970s. Gold cannot be printed. It cannot be debased by a signature on a central bank memo. But it has its limits. You cannot easily scale gold to support trillions in daily transactions. The physical supply is finite. The velocity of trade is not. Some say the replacement won't be a single currency at all, but a basket. IMF special drawing rights, a composite of major currencies, could serve as a neutral standard. Others imagine a technological leap. Digital currencies, backed by commodities, or governed by algorithms that remove human manipulation. Bitcoin maximalists see a world where decentralized currency replaces fiat. But governments do not surrender monetary power without coercion or catastrophe. No empire voluntarily disarms its treasury. The most realistic scenario is messy, a period of multipolar monetary competition. Different regions using different standards. The dollar in the Americas, the euro in Europe, the yuan in Asia, and gold as a neutral settlement between blocks. Not clean, not elegant, turbulent, unstable, and painful. The kind of turbulence that marks every empire's final innings. And this matters not as a history lesson, but as personal survival. When reserve currencies collapse, governments are not the only victims. Ordinary people, their savings, their purchasing power, their retirements take the hit. Portugal's decline in the late 1500s crushed merchants who held reals. The Dutch collapse vaporized middle-class savings in Amsterdam. Britain's post-war descent impoverished citizens whose pensions, bonds, and life savings were denominated in a weakening pound. And the American version. It is happening slowly, which makes it harder to see. Every dollar you hold loses purchasing power. Since 2020, inflation has erased roughly 1/4 of the dollar's buying strength. Your paycheck, your savings, your retirement fund. Same numbers, smaller, reality. And this is only the early phase of stage 6. If the pattern holds, and for 6 centuries, it always has, the next decade will bring accelerating decline. More inflation, more currency, debasement, more nations abandoning the dollar. And when stage 7 arrives, replacement rarely comes gently. It comes as a crisis, a sudden repricing of value, a moment when the old empire pretends everything is fine and markets no longer believe it. The dollar could lose half its value in a matter of months. The pound did in 1949. Reserve currency. Death never looks dramatic until the final act. Then it is unmistakable. What should you do? First, recognize that holding dollars is a risk, not safety risk. The dollar still circulates, still dominates, still seems normal, just as the pound once did, just as the guilder did. Diversify your exposure. That does not mean flee the currency overnight. You still need dollars to live if you are in the yuko. But do not store your entire future in a melting ice cube. Accumulate assets that transcend currency: real estate, productive companies, commodities, land. These hold value whether the world trades in dollars, yuan, or seashells. Second, track the signals. Watch central bank reserves. If global dollar holdings fall faster, the clock accelerates. Watch trade agreements. When major economies settle in non-dollar currencies, that is the sound of the foundation cracking. Watch gold. If it surges, it means the world is evacuating fiat. This is not about politics or emotion. Reserve currencies are destroyed by mathematics, deficits, debt, debasement. The same numbers that killed the real, the guilder, and the pound are now devouring the dollar. And here's a detail most people never notice. The lifespan of reserve currencies is shockingly consistent. Portugal's real had 80 years. The Dutch guilder had 80 years. The British pound 105 years, all between 80 and 110 years. The US dollar became the global standard in 1944. That was 81 years ago. We are right at the historical average, and the symptoms are all there. Massive deficits, cascading money printing, shrinking confidence, reserve diversification. Stage 7 asks a single question. What replaces the old order? What is different, this time, truly different, is scale. Every previous reserve currency collapse was regional. Portugal's collapse affected Iberia and colonies. The guilder affected Northern Europe. The pound affected Britain and the Commonwealth. The dollar affects everyone. Every central bank, every commodity market, every sovereign debt contract. Global trade is denominated in dollars. Oil, metals, food, all priced in the system that may be entering its terminal phase. When the dollar breaks, the shock wave is not local. It is planetary. And transitions of that magnitude are never smooth. They are violent rewirings of wealth. When the pound died, the world had a clean replacement, waiting the industrial machine. When the guilder died, the British Empire was ascendant. When the real died, Spain's silver empire dominated the seas. Today, there is no obvious successor, so the transition will be slower, uglier, and far more destructive. Understand this clearly. I am not predicting the United States becomes a failed state. I am not urging panic or exile. What I am saying is that the pattern exists 7 stages, repeated across empires, and the dollar is deep in stage 5, bleeding into stage 6. Breaking the pattern would require reversing deficits, ending endless printing, rebuilding productive capacity, and taking political pain voluntarily. No reserve currency in history ever chose that path. Democracies choose comfort, stimulus, short-term relief, not sacrifice. And so the cycle continues. Stage 6 becomes stage 7. Wealth moves quietly first, then rapidly. Those who understand it position early. They hold durable assets. They diversify across systems. They watch the indicators with cold eyes. The pattern is not conspiracy. It is not emotion. It is economics, repeated for 600 years. The only question is whether you recognize it before the curve steepens, or whether you become part of the liquidity that transfers wealth to those who did. 4 reserve currencies, 7 stages, 80 to 110 years. The script has not changed. Only the actors have. And right now, the spotlight is on the dollar.